Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 47. So let's just call this episode what it is, bear market. So in this episode, I just want to talk to you about what a bear market is, give you some data to help back up what does it mean, how long does it last, how bad does it normally get, so that you can arm yourself with that knowledge to put it to good use in your portfolio. So that's what today's episode is going to be about, and hopefully this will be some surprising facts for you in this one that make you feel a little bit better when you're seeing so much red on the screen. So as always, let's get to work. Okay, well, welcome back to the show, everybody. If the market keeps having weeks like the past couple of weeks we have, I might not have any listeners left. We might just be running for cover, if you will. So this past week in the stock market, another down week when Walmart and Target reported. It just had this massive impact on the market. And you saw stocks lose just so much money this week. So this is our eighth year. God, I hope not. 8th week in a row for the Dow Jones to be negative. So let me just put that into context. The last time the Dow was down 8 weeks in a row was in 1923. 1923 is the last time it happened. And so every week I'm telling clients, hey, I got all this historical data. We've never had this many weeks down since then, since this, nobody wants to take my phone calls anymore because we just keep setting these horrific records. And so when you look at just the landscape, it's just ugly out there. So Target reported earnings this week. They were not good. They had the wrong inventory. Consumers weren't buying. At the start of the week, Target was $215 a share. It closed the week at $155. So the Tuesday to Wednesday drop was the largest single day drop for Target since 1987. So, we're hitting these just, records from all these bad times in the market. And so it's really hard for people to stay objective when they're seeing this much red on the screen. But again, this is when our emotional intelligence comes to help us, because we have to be level-headed. And when you see things happen, so Friday, the S&P 500 dipped into bear market territory. So just to remind you, a bear market is considered a 20% drop from your all-time high, So a 20% drop. So Friday it happened. Like the market started off well on Friday, immediately sold off. And then, one of the reasons that people, say the market is rigged and, things like this makes me kind of, understand where they're coming from, is that the last 25 minutes of trading, the Dow Jones and the S&P came flying back. I think the Dow at one point was down almost 500 points on Friday. And in the last 20 minutes of trading, like I said, it comes all the way back, which means, there's, at the end of the day, that's not retail investors pushing that up at the end of the day on a Friday, right? That's some institutional buyers, big money going, okay, there's some deals out there that we see that we haven't seen in a long time. We gotta go after that. So it'll be interesting to see what happens this week. But on Friday, Apple got down to $132.82, which I still cannot believe. That is so low for Apple. My goodness. Apple's gone from, let's see, at the back in March, January, it was almost 180. Let's see, 177, 175, somewhere around there, down to 137, just a massive move down. And so, every time you watch TV, they're talking about a recession and a bear market, all these things, right? So that's what I wanted to spend time on today, is just to talk to you about how long does a bear market last? What does that entail? What does that mean? It sounds scary. And then, how can you use that to your advantage? Right? How can you use this to your advantage and really just kind of steady ourselves mentally and figure out the best way to use this to our advantage? So here's some facts on bear markets. The average length of a typical bear market is 289 days. 289 days, which is about 9.6 months. So let's just call it 10 months long. Okay. And so since 1928, there's been 26 bear markets, and there's also been 27 bull markets. So, kind of tied here. But one thing to keep in mind is that a bear market, again, 289 days, and a bull market is typically 991 days, or about 2.7 years. So the bull markets tend to last much longer than the bear markets. And so, we've had a good run here because typically 1 out of every 3 years in the stock market is a negative or a down year. And so the last couple of years we've had they've been okay. So the last bear market we had was in 2020 during COVID. And that was super painful because that was the fastest bear market we'd ever gotten to. Almost like a week and a half. I mean, it was just tremendous, right? So that's a lot of pain quickly. This is more of a death by paper cut, slow and drawn out, which not sure. I mean, now looking back, I remember how painful 2020 was. And of course, our memories always, help us not remember things as badly. But man, that was just brutal. But it was so fast and quick that you didn't really realize it. This time, you get to see it every single day. So, but a couple things that are interesting here, and this just goes to staying invested, right? So when you look at data that talks about how's your performance do, it shows that if you get out of the market, that you're going to end up hurting your performance, right? But when you look at these charts, it just seems like, man, if I could just time this. But I think we've talked about this before, but I always want to go back to this because I do find it important. But when you look at the data, like 20 years in the market, so the one I'm looking at is January 1999 to December of 2018, right? So that includes the tech crisis and drop. It includes the financial crisis of 2008. And if you would have been fully invested the entire time, you would have made 5.62%. 5.62%, which was not great, right? Not a great 20-year period. But if you miss the 10 best days in the market, the 10 best days of that 20-year period of time, so we're talking about the best day every 2 years, you cut your performance to 2%. And if you miss the 20 best days, you're already negative. If you miss the 60 best days, which would have been the 3 best days a year, you're actually at minus 7.41%. You would have lost money had you been out of those days. And so I bring that up because half of the strongest S&P 500 days over the last 20 years happened during bear markets. And I know I've said this next fact, but most of the best days in the market happen within 2 weeks of the worst days. And so, when you know this intellectually, as one of my favorite listeners always says, you got to be on the dance floor, right? You got to put yourself in a position to be able to have those good days. And so, like I've said, week after week after week, I know this is getting annoying, but you got to look at your share count. You got to look at the companies that you're in, making sure they're solid companies that have earnings, right? Do they have earnings per share? Are they growing those earnings per share? Companies that don't have a lot of debt, right? Go back and listen to the balance sheet episode where we discussed this, right? You want companies that are in good financial condition that, for everything that you see, looks like a very solid company. And then you want to try to Save as much money, invest as much money as possible while you can. So if you know that a bear market is only 10 months, you should be thinking, man, I got to be able to save as much money or invest as much money as possible as I can over the next year, while the prices are going to be down, while the cost of things is going to be down. And so, as you start your investment journey, or you're in your, the first bear market of your investment journey, and maybe you're a veteran at this, one of the best things that can happen to you is to see the market drop, ride it out, and then see it recover. Because once you do that once, it makes all the other ones, easier. Because it's scary if you see it happening and you don't have a lot of experience. But many of the clients that I serve that we worked on 2020 together, they're calling me, and they're concerned, but their biggest concern is, hey, what are we buying? What are we getting into? Because they realize that, hey, this could be an opportunity to buy into some really good companies at some great prices. So even though it's painful to see Apple drop, down to 137, I want to remind you that in January 1st of 2020, Apple was $77 and it dropped to $63. And so $77 to $63, and then now it's all the way up to $180, down to $137. So it's still way above where it was in 2020 during COVID. And so that's kind of my point, is that yes, it's painful, but it also allows you the opportunity to get into companies, at a great, at a better price. And if you're willing to be patient, it could be a great opportunity for you to basically set the foundation for your portfolio. So this won't be as long as a normal episode of ours, but I wanted to leave you with a couple strategic tips or strategies. I shouldn't say tips, but some strategic strategies to help you navigate this. So if you're looking to invest or looking to improve your portfolios, and you're looking at companies that you want to buy, you have to be willing, whatever you're investing in, you got to be willing to invest a little bit more, right? So what I mean by that is, if you buy Apple, Starbucks, whatever it is, whatever the company, the S&P 500 index, which would be SPY, the NASDAQ index, QQQ, whatever it is, you got to be willing to buy more if the market starts, continues to fall. Because even though I'm telling you the average of a bear market and how long it could last, that's the average, right? So there are bear markets that have gone longer than that. The longest one was 61 months. That's 5 years. That was during World War II. So that's a little bit different, right? That one's not surprising when you look at that being the longest one we've ever had. When the country's at war, obviously the stock market's not going to be doing well. But the average is around, 10 months, a year, whatever it is. But, you have to be willing to buy a little bit more, because the average decline is around 33%. So the S&P right now is down 20, and the NASDAQ, I think, is down 28, 27. So it's almost there. NASDAQ normally overcorrects a little bit. So whatever you're looking to invest in, just tell yourself, commit, and say, I'm going to, next month when I get paid or whenever, I'm going to invest a little bit more and a little bit more, and just keep doing it, something that is sustainable for you, so that you can try to not time the bottom, because you're not going to be able to time the bottom. Nobody's ever, if they do it, it's luck. But if you are consistently investing a little bit at a time, you'll buy some shares that are close to the bottom. It's just the way that it works. And so think about, again, going back, companies that are buying their own shares back, companies that pay dividends, companies that have a history of raising those dividends. And then if there's some companies that have been really beat up that you think you might want to take a chance on, this is the time to be able to do that. There's some companies that are down 80, 90%. I'm not saying you put everything in there, but just a little bit, give yourself some exposure to that. So, it's all about, it just goes back. It's the same themes are showing up over and over again when we do these. but it's consistency, right? So consistently just invest some money. Don't think about what it's doing every single day. That's one of the other problems. So when you think about the behavioral finance piece of this, there's something called projection bias. So when the market's not doing well, people project into the future that it's not going to be doing well. There's also hindsight bias, which is looking back and saying, if I would have done this, I would be doing great. If I would have just bought this here, if I would have sold this here, I would be doing, I'd be doing better than I am, which everything looks better when you're looking back. And so there's also myopic risk aversion, which means the more often you look at your investments, the riskier they appear. And so that's definitely happening for investors right now because they're watching it all the time, seeing it on the news, checking their portfolios. So, you got to work on that emotional intelligence as well. And if you do these things, you can do better. You can make it through to the other side, right? And so I always think about, I did that Omaha trip a couple of weeks ago, and Warren Buffett was talking about how he had already bought $600 million worth of Apple in the low 150s and said he didn't buy more because it started to go back up. Well, I see how low Apple is right now, and I know he's buying. I mean, I know that when it comes out at the end of the second quarter that he will have bought a lot more. So I'm excited to see that. But these are the things you have to keep in mind. And if you haven't invested yet, this is probably a good time to start to seriously consider starting your investment journey because you are going to be able to buy some really high quality companies or invest in some really high quality companies at very attractive prices. And so you got to step into the fire a little bit, but you also have to commit to keep going if times get even worse. So with that, I hope you have a great week. I appreciate you listening. Our Instagram page is doing amazing. We are getting tons of followers. I appreciate all the shares. I appreciate y'all leaving comments about the podcast on whatever platform you're using to listen to it, because we have grown a ton in the past 3 months. So I appreciate that. I hope you have a great week, and I'll see you next time. Thanks, everybody.